Hello and welcome back. This is Ike Hoffman with Tactica Real Estate Solutions, and we are underwriting a 40-unit multifamily value add deal. This is the second video of a two-part video series. In part one, we first qualified the project with just a few basic inputs to ensure it was worth our time. We decided ultimately, yes, we wanted to do a deeper analysis. So in this video, we're going to dive in. We're going to cover how to organize the deal data, specifically the rent roll, the profit and loss statement. We're going to input these numbers into Tactica's value add model. We'll make underwriting assumptions and assess the project from there. In this video series, I feature two Tactica tools. In video one, it was the back of the envelope template, a free Excel workbook. Download link is below. And then in this video, I'm featuring our value add model, which is a paid Tactica tool. If you've been enjoying these underwriting tutorials, I'd really appreciate if you like the video, subscribe to our channel, and allowed us to notify you when we're releasing new video content. Let's jump into the value add model. We are on the investment summary tab of Tactica's value add Excel workbook. We have a blank canvas, and let's jump right in and begin filling out our assumptions. We're going to call this project a 40-unit value add, and there's 40 units, and the parking ratio is 1:1, so there's 40 parking spaces. We'll leave the address blank at this point as it won't affect any numbers in the model. We have an agency debt quote for 65% LTV, interest rate of 5.85%, term 10 years, amortization 30 years, loan cost 1%. There's no interest only. This isn't an assumption loan. We'd be taking out this loan free and clear. The broker's pricing guidance was $5,250,000. There aren't any other capital costs we want to account for now. If we come over to the right side of the workbook, we do want to enter in $85,000 in just escrow, closing costs, legal, those typical closing costs. And then we can do a residual sale assumptions. If you recall from video one, we're looking at a B- asset, and we think kind of the market cap rate today is a 5.5 cap. But we want to be conservative when coming up with our residual cap rate. So we're going to increase that by 10 basis points per year. In other words, if we're saying the cap rate's a 5.5 cap today and we sell it in 10 years from now, that would add 1% onto the residual cap rate today. So in 10 years, we'd sell it at a 6.50% cap. Brokerage commission, when we sell it one day, we'll say 2%, other closing costs, 1%, and then we won't have a residual sale fee at this point in time. So that's really all we need to fill out at this point in time on the investment summary tab. Let's go into our other tabs. Now we're on the renovations tab, where we need to enter the unit mix intel and also come up with our rental premiums and capital spend per unit. Let's jump into the property rent roll. So what I like to do is just highlight everything, insert a pivot table. I'm just going to add it on the existing worksheet so it's right next to the bulk data. And then I will do type as the rows argument. So we have our different floor plans. We have two unique 1-bedrooms, two unique 2-bedrooms, and then a 3-bedroom unit as well. We're going to count the types of units as the first value. This is our floor plan breakdown. We'll do average square footage. Change that to average. And then we want the average rent. It's important to note there's also some lease start and lease end data. If I were doing this analysis for a client or for myself, I would also be looking at the rent trends based on lease starts. Hopefully you see those rents increasing, and maybe I can do a separate video on that. I also like to see when lease expirations line up. Ideally here in a cold weather climate, I'm in the Midwest, hopefully you'd see those expirations during the spring or summer months or early fall. It's really hard to release units in the middle of winter when there's snow and extreme cold. So those are some extra things I like to do with the rent roll. But just for the sake of time, I'm going to take kind of the basic information here and get it inputted into the value add template. So I'm going to take this data, I'm going to copy it, and I'll paste as values right into our input grid on the renovations tab. And then I'm going to hide all these excess rows. Obviously, this model can support a lot of different unique floor plans. And now we need to come up with some premium and capital assumptions. Thankfully, I put together a brief rent comp analysis. So we have our 40 unit value add project as the subject property. And then I looked at 4 other comps that were built in the 1970s, similar unit count, all have pretty solid occupancy, similar location ratings. Probably the most important part, though, is all of these properties I've been looking at have had a renovation completed or at least a partial renovation. So really, we're trying to determine kind of what the upside is if we were to renovate all 40 units. Another interesting observation was 2 of these comps, Comp 2 and Comp 4, also are billing their residents back for RUBS. The current ownership group of the 40 unit we're looking at is not doing that. So that could be an opportunity as well. When we jump into the analytics, start at top here, interesting, all of the properties that have seen full renovations are above 95% occupancy. There's a nice summary just of kind of the square footage and the rents of various unit types and how it compares to other properties in this unit square foot and rent section. And then there's a section just dedicated to square footage. So the 40 unit property we're looking at the units are a little bit smaller compared to the rent comp. You can see the 1s, 2s, and 3s are all falling below the average square footage of the comp set. And then the scatter plots is where I think the most value is derived from. Remember, there's 2 unique floor plans for 1s and 2s. And our smaller 1 bedrooms are significantly below the trend line of where the comps are at, where the larger 1 bedroom units are nearly at that trend line. The same thing can be seen for the 2 bedroom units as well. The smaller units are well below the trend line, while the larger 2 bedroom units are right on it. And then our 3 bedroom unit, there was only 1 other comp in the set that offered 3 bedrooms. We're about $200 below where that comp's at. So that's a good sign. And then if we look at the rental data, the rents per square foot are significantly lower than the rest of the comp set, which is another good sign that there's likely rental upside. So let's go back to the value add model and let's begin inputting premium data. So for the smaller 1 bedroom, I'm going to do a $100 premium, but for the larger one, I'm only going to do $50. I want to be as conservative as possible. And for 2 bedrooms, I'm going to do the same thing. I'm going to do $150, and then the 3 bedroom, $200. And then for the capital spend, I'm going to do $6,500 for the 1 bedrooms, $7,500 for the, not 75,000, $7,500 for the 2s, and then $8,500 for the 3 bedroom. We're going to start the reno in year 1. I think it would take about 2 years to knock out these 40 units, which equates to just under 2 units a month. I think that's a reasonable assumption. And then I'm assuming that these units will be vacant for, let's be conservative here. We'll say they're vacant for 2 months during the renovation year. And if we scroll over to the right, I'm going to do a more modest 2% organic baseline rent growth in year 1. So when I think of renovations in value add, I think of rent growth coming from 2 ways. There's just like your baseline inflationary rent growth, which would happen regardless of the renovation. So in this case, I'm doing 2% in year 1. So if your rent was $1,000, I'm saying at the end of year 1, it'd be $1,020. And then whatever premium you decide on would phase in on top of that. So if you do a $50 premium, it'd be $1,020 plus 50, which equals $1,070 in total rent year 1. So it's kind of nice in this value add model. You have control of both of those toggles, both the premium and that baseline rent growth. So I'm doing 2% year 1 and then 3% thereafter. And that's really all I need to fill out on this tab. I will note that there's 3 vacant units at the property right now. Now let's talk property taxes. There were only 3 historical pieces of information that we could pull and utilize in our analysis. So let's go in here. I'm going to update the years. It's 2022 and 2023. And 2023 and 2024 will be the 2 years we have some data on. And I'm going to delete this next row. And the assessment amount the assessment amount in 2022 for payable 2023 was $4,860,119, and then payable was $81,650. So that's been published online. That's what the current ownership group is going to need to pay this year for property taxes. And then there was an assessment published for 2023 that will stipulate what's payable in 2024, and that was $5,059,384. But there's no payable information published yet. That would come out later this year. So I'm just going to delete that. And the model knows then to take this new assessment amount, multiply it by the tax rate that's occurring this year, and then that will flow into the pro forma. We also discussed in video 1 that we thought that this property would reassess at 95% of the sales price, and the reassessment year would take place in year 3. And then after the reassessment takes place, taxes would increase at 3% annually thereafter. So now we need to change this drop down to 2022, 2023. And as it currently stands, we actually are estimating that property taxes could potentially decrease a little bit if we were to purchase this asset at $5.25 million, get a small reduction. Candidly, I don't like that. I don't think it's really wise to project property taxes to go down. So let's reassess at 100%. And then we see a modest 3.77% increase. I like that better for just more conservative underwriting. We would take over this property this year. Our year 1 payable would be this $81,650. The 2023 assessment's already published. So we would see another 4% increase next year. And then in year 3, the assessment would reflect the sales price, and we'd see another nearly 4% increase, and then it'd be 3% thereafter. Let's jump into the financials tab. So we need to input our historical data, and I want to categorize expenses as the following: admin, marketing, management fee, payroll, utilities, repairs and maintenance, grounds, insurance, and property taxes. I'm going to copy that and then paste it into the P&L. I'm going to come down to the bottom of the P&L. I'm going to paste our categories here. Looking at the P&L, I'm going to zoom out a little bit. We have messy expenses. We don't have clear categories, and I don't want to put all 22 of these rows with unique expense codes into the model. So I want to group some things together. And if you saw my video last week on cleaning and scrubbing historical financials, I showed you the steps to do that. I'll link that video below. I'm not going to explain as in-depth as I did in that video, but I'm going to just jump into how I categorize these expenses and get them into a more consolidated form to put into the value add model. So the first thing, I see there's a mortgage interest line item. I'm going to highlight that, and I want to just delete that out. The current ownership's mortgage interest has nothing to do with us. It's specific to them. We're going to have our own mortgage once we take over this property, and it's going to fall. That interest expense will fall below the line. It's not an operating expense. So I'm just going to go ahead and delete that. And then I'm going to come up with some. I'm going to make this column A a little wider here. And I'm going to come up with a unique code for each one of these line items. So I'm going to say A for admin, M for marketing, MG for management, P for payroll, U for utilities, RM for repairs and maintenance, G for grounds, I for insurance, PT for property tax. And then I'm going to just go through one by one and classify all of these expenses. So garbage, utilities, licensing and permits, admin, insurance is I, insurance, janitorial, R&M, office supplies, admin, accounting, admin, legal, admin, property management would be management, MG. The next cluster of expenses would all be R&M, building, repairs, labor, subcontractors. Grounds would be G for grounds. Bugs and pests, we'll call that R&M. Snow removal, I'm going to classify as grounds as well. Parking lot maintenance will also be grounds. Supplies, R&M, and then the rest are utilities, or U. And then finally, the final expense item, property taxes, would be PT. So now I can come down here and I can do a sum if formula. and our sum if range will be our where we code it in column P. We'll lock it. Our criteria will be the codes we entered in column A. Leave that unlocked. And then it's going to sum the totals in column O. Close the parenthesis. And then we can drag down, make it a currency. And we are good. The first thing that jumps out to me is there is no payroll at this property. And when we take this over, we absolutely 100% will have a payroll expense. So that's something that we're going to have to account for that for whatever reason, the current ownership group didn't. There's also no marketing. I think if we're renovating units, making them nice, it would be wise to have at least a modest marketing budget to get qualified tenants to fill those freshly renovated units. Quickly, before I copy and paste this information into the financial model, I just want to sum these categorized units. We have total expenses of $232,690. That matches out to the expense in the P&L, $232,689. So we are good to go. So I'm going to take these and copy as values right into the underwriting section. And I'm going to go ahead and hide 2020 and 2021. If you had information, ideally you could enter that information there, but for the sake of time, we will not plug in that information. I'm going to hide a couple other columns here too that aren't relevant because we don't have that information. And then we can just grab the pertinent T12 data right from the financials. So the 554,000 total rent revenue. There was some laundry income. There was garage parking. And then there was some fee and miscellaneous income. And then I'm going to grab the T12 data as well. So I'm grabbing just the last 3 months of data, and then the model, since we have T3 entered in here, will know to annualize that or multiply it by 4. So I'll grab laundry. And then miscellaneous. And now I can hide this row so we only see the annualized amounts. And T3 isn't trending much different than what the annualized numbers were. They're both 590,000. Hopefully when you do a T3, you see things improving, maybe rents going up, vacancy going down, and you see a higher total revenue. But in this case, it seems like things are pretty steady and there's nothing too drastic jumping out at me in the trend lines. You may notice I also have a utility rebill line. We don't have anything in there right now, but if you recall in our rent comp analysis, there were 2 comps that were charging their residents back for utilities. So that's going to be something I play with in a little bit to just see how it affects the numbers if we were also able to rebill. Let's expand this financials tab and start making our assumptions. So I'm going to run a 5% vacancy, bad debt, negative 0.5%. We're going to increase parking 3%. It's fully parked. There's 40 spaces and they're getting, I believe, $45 per spot. I don't see a ton of upside there. Laundry income, we're going to just increase it by 3%. Fees and miscellaneous, you can see that the T3, T12 trend is down significantly from what it was annualized. And I think it was just bad timing of the T3 where maybe that 3-month window isn't an accurate projection of what it would be on an annualized basis. So I'm going to go in and I'm actually going to just put in a per unit assumption that gets it back to this 7,000 number that they've seen historically. So I'll just come here. I'll come into this cell on the per unit assumption in column Y and say equals 7,000 divided by 40 units. and then we're at 175 per unit, and now it's showing up as 7,000. And then we need to make our expense assumptions. So their historical admin was 13,000. I think we could cut that down a little bit. 275 unit equates to about 11,000. I think we should have a marketing budget, 150 per unit, which equates to 6,000 per year. The current ownership group didn't have any. We've talked to a management company. They're going to charge 5% of gross revenue. Payroll, the management company will allocate some payroll to this property. So we were quoted at 65,000. So I'll do 65,000 divided by 40 units. And that is a 1625 per unit expense. Utilities, we think they're running a little higher than they could be. There were some leaky toilets and just some efficiency improvements that we'd be able to make relatively easily. So 1,000 per unit there. R&M historically was 900 per unit. We're going to cut that down a little bit. We're going to increase their grounds expenses. That was snow removal, lawns, parking lot maintenance by 3%. We have an insurance quote that's a bit higher than what they've had at the property. So we got quoted at 425 per unit or 17,000. And then we'll run a $300 per unit in reserves. So our year one assumptions are complete. You can see our NOI is down about 24% from where it was at historically, and that's mostly because we're adding a lot of expense. Most notably, $65,000 in payroll expense and a $6,000 a year marketing budget as well. Let's go ahead and make our year two assumptions. So I'm going to continue general vacancy at minus 5%. Remember, we're renovating units, and on the renovations tabs, we're holding units vacant for 2 months. So that's reflected here. So those first 2 years, we're going to have a significant amount of vacancy as we're pulling units offline and holding them vacant while we renovate. But once those are done, that will stabilize. And then we're going to increase everything else at 3% a year. All of our expenses will increase at 3%. Run management, continue to run it at 5% of EGI. 3% increases for everything else. And then once we make our year three assumptions, those will flow over. I forgot the bad debt assumption. And I'll keep that bad debt at negative 0.5% for future years. Doing 3% increases for all of our ancillary income items, and then 3% increases for all of our expenses as well. And then the management fee will continue to be 5% of revenue. And then I just like to scroll over to the right where all of the cash flows are summarized. Just make sure everything looks accurate, looks correct, and it does. With the bulk of our assumptions done, we can jump to the return summary and see how the numbers look. I always like to have a small capital contingency. In this particular deal, I'll do $1,000 per unit. We'll allocate that over 2 years. So this is just maybe unforeseen capital repairs that come up that you would need to use cash flow to pay for. So when we come down and look at the numbers, they're okay. They're not great. Equity multiple wouldn't get to 2 until years 8 of the investment hold. Just a lot of sponsors I talk to are trying to get to that 2 equity multiple a lot earlier, 3, 4, maybe 5 years into the hold. The numbers aren't exceptional by any means, but there was that opportunity to potentially phase in a utility bill back. Let's go back to the financials tab and see how a utility bill back or RUBS program would improve the investment metrics. So utility rebuild, we think we could bill back $50 per unit on average. It'd be less for the 1 bedrooms and more for the 3 bedrooms, but across all units, we'll say that's $50. So we'll take $50 times 12 months. But remember, we're going to have to phase this in as leases expire, so we won't see the full effect of this in the first year. So let's multiply it by 50%. So $300 per unit, which would be $12,000 per year, which would be $12,000 in utility rebuild in year 1. And then we'll just multiply that by 2 in year 2. So it'd become fully stabilized in year 2 and then we could increase that by 3% a year. So now we come back to the return summary, and the IRRs jumped considerably. They kind of bottomed out at around 10% in these late years. Now we're getting close to 12%. So that definitely made an impact, but there's still probably not enough meat on the bone to pay $5.25 million. I think really the only solution to make the numbers work would be a price reduction. The $5,250,000 is just too rich for what this deal could provide. So now I would start playing with the price, and at what pricing threshold do the returns start to make sense. And in this particular deal, I think a $500,000 discount would make this project a lot more enticing. Now you can see the 7-year IRR gets up to 15.5%. If we go to the return summary, the equity multiple would get above 2 in a theoretical sale in year 4. The debt service coverage ratio is above a 1.2 right away in year 1. And the simple interest waterfall is a lot more compelling for both the GP and the LP. In this case, the project would get into the third hurdle and the LP would more than double their equity in 7 years. In summary, we underwrote a 40-unit multifamily value add deal, but unfortunately at the pricing guidance of $5.25 million, the numbers are just too skinny. We were as optimistic as we could be, obviously backed with rent comp data with our rental premiums and potentially even phasing in a RUBS program where we could bill residents back for their utility usage, but there just isn't enough cushion at the current pricing target. So the next question would be, is it worth submitting an offer for $500,000 less where the deal starts to make more sense? That'd be a question for the broker or the seller if you're talking to them directly. But hopefully the value derived from this video was how to input everything that you would get from a seller or a broker into Tactica's value add model and some of the steps you can take to stress the deal and really test certain toggles to see how it impacts the overall returns. And if you're working with other people and investing with other people, how those things can affect the partnership returns as well. If you've been enjoying these underwriting tutorials, I'd really appreciate it if you'd like the video, subscribe to Tactica's channel, and allow us to notify you when we're releasing new content. I really appreciate you tagging along for this 2-part video series. We'll catch you next time. Take care.